Hi, Dominique. Welcome again to another edition of the week ahead key events, I guess, and the week ahead. I mean, I feel like I'm trying to do this kind of smoothly or kind of innovatively, but it doesn't have to be. I mean, this week once again was an incredibly interesting and bizarre week. As we've seen almost every week this year, certainly probably since like February, March. Maybe let's kick off kind of starting with everything from last week. Obviously, the big thing was CPI, but kind of the data, Fed speeches, market interpretation, what you think is here. Obviously, some people are viewing this as kind of a watershed moment. I would say it also kind of fit into some people's view that this narrative, not like there's a big pivot coming, but that maybe they'll slow down a little bit or should, at least to 50. And it seems like has been some of the Fed speakers kind of laying the groundwork, at least the more dovish ones, of the last couple of weeks. But I'll pass it off to you. Kind of, what's your overall interpretation of however you want to kind of lay it out, the details of the data, which we as investors should really take away from it. What comments from Federal Reserve speakers around that before or after, and then obviously we'll go ahead for the week ahead after that.
So data-wise, we've had 3 months of positive surprises in the CPI, and this week we had one positive, negative surprise. If investors want to think a little bit ahead, they need to look at the trends. The indicators of trends are not suggesting that inflation is heading down. If you look at indicators such as the trend mean or median price, which are the better indicator of trend when inflation is high, those are still elevated. The Atlanta Fed finally released its median wage. It's up relative to the previous month. The big picture, the macro big picture.
What was the number? What is it?
It was
Atlanta Fed saying that it is?
It was up 10 basis points year on year on the previous month. I think 6.7 or 6.8%. But I mean,
okay, pretty high.
I would love
not 2%.
No, I would love to live in a fairyland where there would be, I don't know, God or whatever you want to call it, maybe the God of market with a magic wand that would shake the magic wand and suddenly all of our macro issues would get resolved. But sadly, that's not how the world works. So we just said basically a market overreaction to one data point. And it's very clear that the Fed is not changing its view. Everybody, including the Dove, has been saying that one data point is not enough. And besides, they don't just look at price data, labor market data, and broadly speaking, data that gives you a sense of where growth is headed is also very important. We had very interesting comments from Lori Logan, who is a new president of the Dallas Fed and used to be my boss at the New York Fed, who was on every FOMC meeting as a head of markets, and so has worked very closely with Powell. And she said, the CPI is good news, but we are still a long way away. Her way of from where we need to be. Her way of summarizing the situation we are in is, as she said, 5 words: inflation is just too high. And she said that investors should not mistake a slowdown to 50 basis point hikes as a sign that the Fed is easing. And as Powell himself said during the presser, What is important is where we are headed, so the terminal rate, more so than how slowly we are headed there. And he made clear at his last press conference that the terminal rate was going to increase in the December SCP. So for me, we've just had one data point that was not as bad as the previous one. So this likely reflects noise rather than a trend. And that's that. And so the market reaction is a bit exaggerated.
Yeah.
And let me just
Can I ask you a quick question on that? Is there any specific points in that data that you're like, oh, because I saw something on, I think it was a Twitter or something, or somebody shared with me, healthcare costs dropped a lot, and that looked to be very spurious. And, you know, if that goes back to kind of trend that it's been on, it actually would not have, it would have been right in line. And that was one of the points. Do you buy that? Or your view is you're taking this face value, and just even taking it face value, you still feel it's like one number, and that they're not, and you're not going to change completely the view? Or do you actually think the number was a bit misleading? Because I didn't ask you that during the week, and I just wanted to ask you that anyway.
So the most important, the noisiest data point that really dragged the number down was a 2.4% decline in used car prices, which was a bit of an outlier. And health costs, it's a little complicated. It's different in the CPI and the PC. And in fact, I'm thinking that I'm going to write a weekly about it, because a few weeks ago, we had a guy who is an inflation specialist who was interviewed on Odd Lots and explains that due to accounting practices, to the way the CPI is constructed, the price of health insurance was going to come down, which is true for the CPI, but not for the PC, because health insurance in the PC is computed directly. Let me just say, this is a very complex issue, which I'll probably write up in my weekly, because everybody, since this Odd Lot podcast, everybody is talking about it.
Right.
I'll say insurance itself in the CPI is less than 1% of total weights. It's a little bit more in the PCE. But the bottom line is that in America, the American Medical Association is an incredibly powerful lobby, and that puts a floor under any decline in medical cost insurance.
Right.
At big
medical costs have been going up significantly for however many years.
Well, I look at the cost of my health insurance, and the service.
Health insurance has been like 5% a year from my experience, even when we were back in Florida for 5 years.
It is really scandalous. But back to the CPI. And the thing about medical costs, even though it's private sector driven, actually the government has enormous influence through Medicare and Medicaid. And so what you have is, instead of a smooth adjustment, you have step adjustment. You have conventions that have very, sometimes that are not very closely to what is really going on. So all I say, it's complicated.
What could be a trend over 3 or 4 months may just get shown in 1 month as a step move, as opposed to.
Exactly. So I'm going to write about this, because I don't want to get on the weeds.
Fine. Yeah. But I wanted to ask, so even just taking it at face value, you still feel like it is actually one data point, sure, and you and the Fed are not going to completely change because of one data point. The one part, what is your view now for December? Because to me, it does seem like 50 is a done deal, barring like something really massively different. And it goes back to the point, like 2 months ago, you yourself were saying, who have clearly been an outlier in the industry, calling for the 8%. You yourself said they probably should start moving to 50s from December onwards. So what is your view now for just December meeting? By the way, what I think, even if it's 50, it could be like the next 4 meetings of 50, not 50, 25, 25 or whatever, but first just for December.
So as always, I'm just listening to what the influential FOMC members are saying. And at the last presser, Powell hinted that 50 would start in December or in January. So my view was 75 in December and 50 in January. And frankly, looking at this data, this CPI, looking at the strength of NFP, looking at the wage data of the Atlanta Fed, I'm still holding out for 75. We have another NFP before the December FOMC. There is also something going on in the background, which is very interesting, market not paying attention, which is that the Fed staff, who completely misled Chair Powell with their transitory inflation story. And interestingly, when he was asked at the last presser what was the Fed staff estimate of trend inflation, he refused to give a number, which shows that he has little confidence. So they've said in the minutes that they were revising down their estimates of trend growth, which means that resource pressure, they are now thinking that resource pressure is much stronger than they thought before, which is a way of explaining their past error. So we don't know what this estimate is going to be. And obviously, if you look at the SCP, the estimates of trend growth, trend unemployment have not changed from before the pandemic, or not changed much, even though they have been quite important.
What is trend growth?
Trend growth
is 2.25 or something, or like
1.8 or 1.
Okay, yeah.
Below.
And obviously, we've realized that a lot of this, a lot of key data points are much more volatile and difficult to predict for good reason since COVID. But is it true that the Atlanta GDP predictor for Q4 is now like 3.6 to 4?
It is very possible, but I wouldn't bet my life on it because
sounds super high. Yeah, I mean,
those guys. And also remember, the Atlanta Fed, unlike the New York Fed nowcast estimate, the Atlanta Fed tries to predict the first release of the GDP, and sometimes they are very, they are quite important revision between the first and the second and third estimate. But there is a risk, and it's not my best case scenario because I don't have enough data points yet. There is a risk that growth could be picking up in the fourth quarter. And if we get enough evidence of that between now and the December meeting, I'm betting on 75.
Yeah. Yeah, I'm just looking. So right now, about 50 is priced in for December, and it looks like basically, just 50, and then somewhere between 25 and 50 for Jan, and then it starts slowing even from there, and then the all important cuts starting, it looks like, after May. Which, obviously we and a lot of people don't necessarily agree with. Now, maybe that's changed this past week. So just to put a final cap on it, were you surprised by the market react? I guess you kind of were, and I know Bilal and Dalvier and Ben have done so much model work over the last kind of months, say just on positioning stuff. And a lot of it showed very heavy positioning from the spec community in short fixed income, short equities, short gold. Lo and behold, super long dollar. And by the way, not necessarily like we disagree on a lot of those calls, but the market could be positioned one way. You had there's still a lot of cash on the sideline, and this kind of fed on to a short, obviously some massive short-term movements. Were you surprised in any way, I guess, or?
Sure. I mean, it was an enormous reaction, and also I think there is something going on in the backdrop here, which we discussed a bit last week, which is I think we are changing regime. We are moving to a regime with much higher yield, and that regime means that the economy will be less financialized, because what supports the growth in financial assets? Low real interest rate. And those days, I think, are gone for the reasons we
no matter what. Yeah. And that seems like a global phenomenon, at least US,
totally.
Europe, Japan, whatever. Yeah.
And one really interesting factoid, which is consistent with that, is tech. There was an article in the Wall Street Journal this week about people in tech looking for jobs, massively looking for jobs, lowering their expectation of wages, and headhunters being delighted because finally they could get the people they needed to work at Walmart and other unexciting places.
Yeah.
And I think this is a sign of a move to a higher yield regime, because tech does well, since the characteristic of tech is that the big profits are in the future. They do well in a low rate environment, but in a high rate environment, obviously, no longer, which, by the way, shows the benefits of a high interest rate in terms of increasing the efficiency of the allocation of capital.
Sure.
I have nothing against tech, but hey, look at what happened to FTX. Look at and that's because
the old adage of venture was supposed to change the world, and all we did is take ordering a pizza in 11 minutes as opposed to 14.
Something like that.
We got a package. We got a new toaster in under 24 hours as opposed to 3 days. Not really, and billions of dollars went into those companies.
So long term, this is actually positive for the US economy, and you're going to find it difficult to believe, but I'm actually very positive about the US long term. But the transition to this higher yield regime is going to be very painful. And tech was one of the beneficiaries of your low yield, and market, how do you say, market give off, market take off?
Take it away, yeah. Okay, great. Hey, so let's move forward after this. And by the way, when volatility, say in equities at 25, 30 vol, they come down a little bit, like there are pockets of massive short negative gamma too. And, that vols at that level, you should expect, 1.5%, 2% type moves on a consistent basis, no matter what. Maybe not 5%, but that's why you do often get these, let's call it bear market rallies, and they're pretty violent or volatile, because volatility is so high, and you do have these heavy pockets of negative gamma. So going forward for this coming week, I guess first let's go. What's the key data stuff to look at?
No question. It's retail sales. And again, talking about inconsistency in market thinking, if there is such a thing as a market, because it's actually, a sort of voting mechanism for very, very different type of investors. But 1% is a consensus, which is great, but is not consistent with inflation coming down. So I agree with the consensus, especially since we have this ongoing transition from lower non-durable consumption to higher services consumption. So yeah, I think this is very reasonable.
Yeah, I'm looking. So all this stuff. So retail sales last month was 0, and this month is 1%. Now maybe there's some funny thing with the numbers, but that seems like a massive jump.
Yeah, but I mean, look. I mean, with COVID, data has become more. I mean, the world has become more volatile with COVID because,
so like you said, also
the data collection capacities have weakened. So again, so that's why it's super important for our auditors to have a model in their mind, a sort of a broad idea of where the economy is going, and then compare the data news to that model and not be swayed by a single data point.
Yeah. We never talk about, I'm just looking through some of the other stuff coming up. Capacity utilization, which is pretty high right now, certainly not seem indicative of a recession. Is that a number you look at that people should be looking at more, or not really?
So capacity utilization is basically for manufacturing, and manufacturing is a very small part. I mean, not very small, but I think
we're still like a service-driven economy.
Yeah. So unemployment.
That's really what it is.
My 3 variables. I mean, basically indicators of labor market tightness.
Right. PPI. Oh, it says, is this PPI? This is like, it says final demand. Is this just like,
So the PPI, the PPI, basically the producer price index. And the most interesting little gem in that mountain of PPI numbers is, to me, it's semiconductor prices, chip prices. Because, there is all this doom and gloom at chip manufacturers. But if you look at the price of semiconductors, it's still going up. It was going down before the pandemic. And there, I think the pandemic was like a catalyst for a trend that was going on for many years, which was a decline in the productivity of chip manufacturers. More so, the number of transistors that you can cram on a single wafer, that was doubling every year. This was
whatever Moore's law.
It's over. We need a new technological breakthrough to restore productivity and restore semiconductor price deflation.
Well, I think also like Bilal did a report, I think it was like not this past week, but the previous week, looking at the impact. So me included are just, okay, so US and its allies are not allowed to sell very high performing semiconductor chips to China. I thought that was the story. But what he was showing was how integrated the supply chain of producing these chips are, and that China is part of it. And there's a bunch of, friendly, but not that friendly countries to the US and Europe too, in question about their participation. So I can understand that probably is not helping in,
of course. And that's
another issue, which could be they're just not producing enough chips, and this will make it worse too, as opposed to maybe there's a surplus or something.
No, totally. And geopolitical fragmentation is one key reason why I believe we are going back to a high yield environment. So 100%.
Yeah.
So what else do we have? We have the residential real estate market indicators. If you are looking to put your house on the market, you're not going to be happy. On the other hand, I'm not. And for me, in terms of my big picture macro view, what's important is that the weaknesses in real estate get limited to real estate, that they do not, because real estate is 3.5% of GDP. The really important thing is consumer demand, consumption.
Right. But there's also jobs, it's higher than that.
It's higher than that.
But this is why I thought like real estate was like 10% of the US economy. It's not.
Okay, it is if you include consumption of real estate services. So the thing, remember the that everybody is talking about. It's the price of consumption of real estate services. And that, my dear, is going up and up in real terms. No sign of weakness there.
Yeah. I guess the last thing is, I feel like this week, probably more than, well, a couple of different times during this year, but this week, hearing from the Fed speakers will be super important, because this is the first time probably since June where there really is a debate. Like, I think we're already heading into a deep recession, which obviously didn't come. You were 100% right about that. So this now is the pivot, or the beginning of the pivot, Are you looking out for Fed speakers who are like the most important one or two to really listen to?
So they are all out talking. And what's important to me is that I think we are going to hear from even the doves that moving to 50 basis points to a slower pace does not mean that the destination, so the terminal rate, is lower. And I think even from arch doves like Cook, like Brainard, Williams, I think they are all going to go on the same sheet. And also remember that for the doves, the worst that can happen is an easing of financial conditions.
Right.
Because, this will completely weaken their view that the Fed should go more slowly, because the Fed believes that policy tightening gets transmitted through financial conditions. So if financial conditions loosen, when inflation is in a 6 to 7% range, they have to hike faster. Forget about moving to 50 basis points. So that will be interesting to see. But I'm expecting that they will sing in unison this week about, don't get over your skis. We're still a long way away from where we need to be in terms of inflation.
Okay, last question. Brainard. Where is she?
Brainard, not Brainy.
Sorry, Brainard. Where is she?
Very brainy person.
Very brainy, yes. I'm holding to my theory. I was like, I think she probably wouldn't have been a better Secretary of Treasurer than Yellen, from my kind of limited experience in understanding with her. Because she's quite influential, and she's always historically been very much on the dovish side, but she seems a bit more balanced. But she was one of the first ones probably 3 weeks ago to get out in front and say, well, we have done a lot. And, she's also, not pushing back, but, we do monitor the dollar, the effects overall in the global economy, just at least mentioning it. And obviously the market kind of jumped on some of that. Is she speaking this week? And where would you put her on the 1 to 10 from dove to hawk?
So I think she belongs with Cook and
okay,
Williams.
So she is. She's a pure dove.
A bit less dovish because now she's a vice chair, so she has to take a more balanced view. And also remember that when you get to where Brainard is, you have to be not only very smart, but have a good sense of political wins and be very careful on how you spend your political capital. Now, the doves credibility has been blown away by the transitory inflation that turned out not to be transitory. So I think she's going to be very careful in how she positions herself. And in fact, in her last speech, what was really interesting and shows that I spent far too much time listening to all the little details. But when she talked about the risk of inflation slowing, she didn't say, I think. She said, she used a passive word, other people think. So this is definitely
Trump.
Definitely someone who is not going to tie her lot to a sinking ship. She's not going to take the risk of being very wrong another time. So that's why I expect her to be less dovish than, for instance, Cook.
Well, this has been awesome. And I feel like I mean, I always feel like it's super, super important, super helpful. We always, we've gotten such great feedback. We went to see a client, I think a week ago, and they're like, "Oh, I feel like I know you and Dominique."
Ooh, maybe I should be more comments.
Wait till we try our avatar next week. So before we go, just want to make sure for all our kind of our listeners, our clients, I'll just highlight a few things. Certainly, it started on the prime side. The news came out, which a lot of people have reached out to us about Joseph Ackerman, the former chairman and CEO of Deutsche Bank, had joined our advisory board, which we're super psyched. And yeah, that kind of a pretty big deal. And I think it's another kind of
validation.
Validation or progression of how we're really kind of continuing to grow and evolve as a company. Some of the other things are just the articles. Obviously you wrote a few articles on inflation and how to take that, which is super, super valuable. Bilal and Martina have been continually releasing their videos of 25 years in finance for Bilal, and really his life lessons, which has been awesome. And I highly recommend, especially for younger people or people not even in the finance industry. It's some really cool insights, and Bilal's such a kind of like a thoughtful, balanced person in general, that the way
I recommend it too, and I am not that young anymore.
Yes, me too. Yes, so highly recommend that.
And I think our listeners should listen to it, really.
Yes, absolutely. And and Delvere had done a bunch of stuff. I heard maybe there was some volatility in crypto this week. As a friend pointed out, if there really is $7 to $10 billion of funds disappearing or lost, that it's larger than LTCM. Now, obviously, the world has changed in 20 years or whatever, 23 years, but that is insane. So we look at, again.
But one last little comment, and pipe up anymore, I promise. Yeah. What does that tell you? It tells you that there is such a detachment of the financial economy from the real economy that you can have losses bigger than LTCM. And then the Atlanta Fed GDP now forecast that is going gangbusters.
Right. Yeah. LTCM, for our young listeners, there was a point where that was going to bring down the global financial system. If something wasn't done. So it does say how much liquidity is still in the system. And then another great point of we're not excited about telling people that we think interest rates are going to continue to have to go a lot higher. We understand in many cases this is bad for people's portfolio, jobs, and all this stuff. We're just telling you that for the reasons that we believe, and from the data, our understanding is they're going to have to do this if they're really going to follow their mandate. So, and then on the pro side, a couple of cool pieces I thought was Caroline looking at Turkey could actually be interesting, not in the super long term, obviously with inflation at 80%, but I had another client who was mentioning looking at Turkey Swiss or Turkey yen, but Turkey as a possible kind of carry currency, at least for the next kind of few months. At least that was, she broke into, there's plenty of risks to this idea too, but it was a nice paper analysis. Henry did an update as view around natural gas, targeting European natural gas and why we're not completely, I wouldn't say out of the cold, but that would be the pun the wrong way. Or is it right? But basically, there's still a lot of risks out there. Obviously, we're still in November, but I can tell you, I was watching my son play football or soccer, as I would know it, in a short sleeve T-shirt today in London. So global warming is real, but there's still a long winter to go, and obviously we hope it's not bad. but there's plenty of risks. There's also logistical risks and infrastructure risks still there for around European natural gas. Dalvier, especially for all fellow, I would say probably people way more technical than me. People focus on derivatives. Dalvier released a really interesting report, which is the beginning of a much deeper series of products and services around derivatives and pricing, and I guess different kind of pricing tools, looking at kind of the different pricing models around Bitcoin. And that's an interesting report. Please, if anyone can't find it, ask to resend it. I can resend it. And then just an update on all the continuing stuff, cool stuff that we've been doing, looking at the models and indicators and positioning. And somebody had suggested that we should do a webinar in the next kind of 1 to 2 weeks, where especially Bilal and Dalvier could go through all the model work we've been doing. Love to hear. This is for our professional clients, particularly, any feedback, inside stuff that people want us to build, especially as we continue to grow as an organization. That would be great. And thank everyone as always. Thank investors. I would say the last couple of weeks feel like they've been good. We've been getting some super exciting. Have had a lot of clients joining the professional service, which has been awesome. And I know it's because of obviously people like you, Dominique, obviously, and your insights and also just
work.
Yeah. And because I think people know we love it, and we love the markets. We love our clients. We want to be there and really appreciate it. And that's every aspect of the business. So thank all of our clients. Thank you, Dominique. I don't know if any other parting words or anything.
My parting words are, we just love our clients. They are so smart, and I get so much out of their questions.
Yeah.
They certainly keep me on my toes. So my parting words, as always, are thank you for listening and good luck on the markets.
Awesome. Okay, cool. Thanks. Bye.
Bye.